Welcome! Today, we are going to dive into a classic problem that trips up so many investors. You're scanning a report and you see this beautiful, shiny number, a high return on equity, or ROE, and you think, yes, I've found a winner. But what if I told you that exact same number could be pointing to the next big thing, or to a company that's about to go belly up? You see, these common metrics can be incredibly misleading if you don't know how to look beneath the surface.
All right, let's jump right in with a scenario. Picture two companies, Company A and Company B. Both of them are proudly reporting a 20% return on equity. Now, on paper, they look like twins. Both seem equally skilled at turning shareholder money into profits.
So, here's the million-dollar question, right? Which one is the future superstar and which one is a total disaster waiting to happen? The thing is, the answer isn't obvious at all. And picking the wrong one, well, that can be a seriously painful mistake for your portfolio. Today, we're going to break down exactly why these two identical numbers can tell two wildly different stories. To really get to the bottom of that 20% number, to understand the real story, we need a secret weapon. It's a powerful tool called the DuPont analysis. Think of it as a way to put ROE under a microscope and see what it's truly made of.
But hey, forget about complex formulas for a second. Let's make this super simple. Imagine you're running a steamed bun shop. That's it. If you want to make more money on your investment, that is, boost your ROE, there are really only three ways you can do it.
Okay, so let's break down these three paths to profit. Each one is a totally different way of running a business, and each comes with its own set of risks and rewards.
Path number one is what I call the luxury bun strategy. You're not trying to sell 1 million buns a day. Instead, you're crafting the most incredible, delicious bun imaginable, and you're charging a ton for it. Every single sale makes you a huge chunk of profit. This is the world of luxury brands, where high margins are everything.
Now, path number two is the polar opposite. This is the fast food strategy. You're cranking out buns as fast as you can and selling them for just a tiny bit more than they cost to make. Your profit on each one is razor thin. Success here is all about volume, speed, and efficiency. Think of places like Walmart.
And then there's the third way, the borrowed money strategy. Maybe your profit margins are just okay and your sales volume is decent, but you pour gasoline on the fire by using debt. You put in $1 of your own money, borrow 9 more from the bank, and open a bunch of new shops. You're using leverage to juice your returns.
Now here is where it gets dangerous. Those second and third paths have some serious hidden flaws. A business that relies on high turnover is super fragile. I mean, a tiny little increase in the price of flour could literally wipe out your entire profit. And the business built on leverage? Well, that's a classic double-edged sword. When times are good, you're flying. But the second there's a downturn, that same debt can crush you.
So it's pretty clear that knowing the quality of a company's ROE is absolutely critical. We'd much rather see an ROE that comes from high profit margins, right? But how does this all connect back to what we really care about, the stock price?
This leads us right into another classic trap that so many investors fall into. You look at stock A and it's trading at 5 times its book value. You think, whoa, that's way too expensive. Then you see stock B trading for less than its book value and think, now that's a bargain. But just looking at the price-to-book ratio can cause you to miss out on the best companies and buy into so-called value traps.
To really get this, let's try another analogy. Forget the buns for a minute. Imagine you get a chance to buy one of 2 ATMs. Both of them cost exactly $100 to build. Same materials, same labor.
But here's the catch. ATM number 1, it spits out $5 in profit for you every single year. Not bad. But ATM number 2, it's a supercharged money machine. It spits out $25 a year. Now, would you pay the same price for both? No way. You'd gladly pay way more for ATM number 2 because its earning power, its ROI, is 5 times higher.
Now, what's so cool is that this isn't just some vague idea, it's actual math. With just a little bit of high school algebra, you can prove one of the fundamental laws of finance. You start with price to book, you do a little rearranging, and boom, you find out that price to book equals the price to earnings ratio times the return on equity. This formula is the golden triangle that links a company's profitability to its valuation.
So what does this all mean? It's a huge light bulb moment. A high price-to-book ratio doesn't automatically mean a stock is expensive. It could just be the market's way of saying, hey, this company is an incredible money-making machine, and we're willing to pay a premium for that. It's paying more for that superior ATM.
But, and you knew there was a but coming, right?
This elegant, powerful little formula has a dark side. It contains a fatal trap for any investor who isn't paying close attention.
You see, that high ROE is only worth paying a premium for if it can be sustained. If it can't, you fall victim to something called the Davis double play. And trust me, it's an absolute portfolio killer because your stock gets hammered from two different directions at the exact same time.
Okay, let's picture the good times. A company's got a killer new product, and its ROE is a stunning 30%. The market loves it. Investors get excited and reward the company with a high valuation, a PE ratio of, say, 25. The stock is soaring, and everyone's happy.
But then the competition catches up. That special advantage starts to fade. The company's amazing ROE gets chopped in half, down to 15%. So not only have its earnings dropped, but the market's excitement evaporates. Wall Street slashes the PE multiple it's willing to pay, from 25 all the way down to 12. So the earnings fall and the multiple falls. It's a brutal 1-2 punch that just devastates the stock price.
So, where does this all leave us? What's the big, critical takeaway here for anyone who's serious about investing their money for the long haul?
All right, let's boil it all down. First, remember that a high ROE can be an illusion built on the shaky foundation of high turnover or risky leverage. Second, that formula, PB equals PE times ROE, is your Rosetta Stone for connecting profit to price. Third, and this is key, a high price is only okay if that high ROE is sustainable, and that leads to the final most important point. Does the company have a real, durable competitive advantage, a moat, that can protect those profits year after year? And this is the final thought I want to leave you with. The numbers, the ROE, the PE ratio, all of it, they're great at showing you what has already happened. But your real job as an investor is to go deeper. It's to be a detective. Your job is to figure out why it happened, and more importantly, why it will or won't keep happening in the future. That's the difference between just looking at numbers and truly understanding a business.